for the long term. We also didn't get here alone. The banking sector has been critical. From the start, we recognized the value of a broad and diverse banking system, from small community banks to the largest players with strong capital and liquidity. And in recent years, banks navigated the pandemic and made it through the regional banking stress, continuing to serve as a backbone for Americans' financial health and our country's economic growth. Community banks, in particular, have played a key role, including by providing a significant portion of small business loans relative to their assets. Let me discuss several key areas of our partnership, starting with our historic economic recovery. The recovery depended on getting money out the door to families and businesses as quickly and responsibly as possible. And this meant working with the banking system, such as to deliver the American Rescue Plan's economic impact payments to millions of families. And this was far from business as usual. Treasury conducted outreach to encourage opening free and low-cost transaction accounts to receive these payments. And banks took action to support their customers at that extremely difficult time, with many community banks, for example, reducing or eliminating penalties for late payments on loans or credit card bills. We also depended on banks for other recovery programs, such as the State Small Business Credit Initiative, a landmark small business program housed at Treasury. Community banks are behind around 90% of the SSBCI loans that are supported by banks. And we see their impact in examples like Spencer Manufacturing. That's a family-owned business in Michigan that expanded its manufacturing thanks to SSBCI support and an over $4 million loan from a Michigan-based community bank. As we marked on the CDFI Fund's 30th anniversary last month, our administration has also provided unprecedented support to community development financial institutions to help communities recover and invest for the long term. And we've continued to work with banks as we've looked to drive strong and inclusive growth. Treasury has announced millions in new SSBCI awards, and we're partnering with CDFIs as we address challenges that have been mounting for decades, such as the drastic shortage of housing units. The CDFI Fund helped finance more than 100,000 affordable housing units last year. And we've worked to expand its impact, such as by launching a new program that will provide an additional $100 million over the next 3 years to support the financing of affordable housing. As part of our focus on driving strong and inclusive growth, we're also working closely with financial institutions to accelerate the transition to a lower carbon economy. Treasury's Principles for Net Zero Financing and Investment support financial institutions that make net zero commitments in taking consistent and credible approaches. And financial institutions are key partners to taxpayers seeking to take advantage of the Inflation Reduction Act, including through the transferability market. I strongly believe that banks must stay the course in realizing the opportunities of the transition and in more broadly considering impacts to business from climate change. And as we look to the long term, we also see banks of all sizes as key to our efforts to expand financial inclusion. For example, the Treasury has supported the efforts of the Economic Opportunity Coalition, a public-private partnership announced by Vice President Harris with bipartisan backing. The EOC's members, including several of America's largest banks, have committed over $1 billion to community lenders to reach underserved communities across the country. And many of you in this room have been involved in other important efforts. Take the example of Reading Cooperative Bank in Massachusetts, led by former ABA Chair Julie Thurlow. Under Julie's leadership, its extensive work to advance financial inclusion has included opening a new branch staffed with bilingual bankers in an immigrant community, providing loans to finance housing redevelopment, and pioneering innovative financial products that meet customer needs. In Wisconsin, Bay Bank, a minority depository institution, is serving its community by providing financial education to tribal citizens and helping them build credit. To move this work forward, I'm proud to announce today the launch of our National Strategy for Financial Inclusion in the United States. It provides a roadmap for the public, private, and nonprofit sectors to promote the ability of all communities to fully participate in our robust economy and financial system. The strategy benefited from a year-long process to gather input, including sustained engagement with ABA staff and members, other government agencies, consumer advocates, and many others. And it importantly focuses not just on increasing access to the financial system, but also on leveraging that access to drive better consumer outcomes like increased financial resilience, well-being, and wealth. It emphasizes the need for action to expand access to transactions accounts and to safe and affordable credit, increase retirement and emergency savings opportunities, improve government financial services, and strengthen consumer protections. Access to safe, affordable financial products and unbiased information can help all Americans pursue financial security. And banks have roles to play across these activities, from facilitating payments to offering credit. We'll continue to seek your active partnership in moving this strategy forward. And as we've driven an historic economic recovery and pursued strong and inclusive long-term growth, we've also focused on working with banks to maintain and strengthen financial stability. In March of 2023, we acted decisively in response to runs at Silicon Valley Bank and Signature Bank that were particularly large and fast by historical standards. After regulators closed the banks, we worked quickly to enable all depositors to access their funds. I also approved the Federal Reserve's establishment of the Bank Term Funding Program, helped by the base of a banking system strengthened by post-financial crisis reforms. We prevented contagion that could have destabilized the broader financial system and derailed our economic recovery. As we look ahead, we will continue to work with you to address the vulnerabilities the banking stresses in 2023 revealed, including increased shares of uninsured and concentrated deposits and unrealized losses on loan and security portfolios. This means ensuring that banks are prepared for liquidity stress, including making sure that banks have diverse sources of contingency funding and the capacity to borrow at the discount window and periodically test this capacity. We will also continue to work with you to address a wide range of other risks and opportunities. The ABA has been a key partner in our multi-year effort to bolster the safe and effective use of cloud services, producing resources to support financial institutions in contracting with cloud service providers. We also launched Project Fortress, through which we're working with financial institutions of all different sizes to pursue offensive measures like sanctions that hold perpetrators of cyber-related activities accountable, and defensive measures like scanning for vulnerabilities. More than 1,000 financial institutions have now joined. And ABA members also provided important perspectives in response to our recent request for information as we've worked to monitor adoption and identify opportunities and vulnerabilities related to the use of AI technologies. And climate-related financial risks also need to be identified and managed. Rising homeowners' insurance premiums and gaps in coverage, for example, could increase risk to lenders. So we'll be considering the risk to banks as well as households as we assess the impacts of climate change on homeowners' insurance and monitor other climate-related risks to financial stability. We also, of course, recognize the growing and evolving role of non-banks in the financial sector and challenges for banks as they both cooperate and compete with those firms. We will continue to monitor and address risks posed by the non-bank sector, including private credit and fintech, and its interconnections with banks. And finally, Treasury's work to protect the U.S. financial system by cracking down on illicit finance depends on financial institutions. Treasury issued new regulations to help safeguard the residential real estate and investment advisor sectors from illicit finance. We've appreciated your engagement and feedback, including on our latest program rule to strengthen our anti-money laundering and countering the financing of terrorism work, which we're working to finalize. We also depend on financial institutions for suspicious activity reports that have enabled U.S. authorities to achieve successful prosecutions and seize billions of dollars involved in illicit finance. That's why we've recently been convening financial institutions and law enforcement officials in key regions to exchange information that will help us crack down on the illicit financing that fuels the opioid epidemic. Domestic and international financial institutions are our frontline defense in other contexts as well, such as in enforcing our sanctions. And nowhere is this truer than with our Russia sanctions, where many banks have been key partners in disrupting transactions that help Russia get financing and goods to sustain its illegal war. Well, as we step back and reflect on the last 4 years, it's clear banks of all sizes have been crucial partners in moving forward many of our top economic priorities. So let me thank all of you for this strong and important collaboration and emphasize that it must continue. Thank you so much.
Well, Secretary Yellen, thank you so much for those remarks. And I was taking notes back in the green room and wanted to start by just saying, really appreciate you flagging the role of some of the non-bank threats in private credit and keeping an eye on that. Also flagging the issue of uninsured deposits. That's an important subject that we have also tackled over the last couple days. Wanted to also recognize the partnership, the areas of partnership between the Treasury and the ABA around fraud, AI, AML, BSA, sanctions. Those are areas, I think, that really demonstrate an important public-private partnership.
We really appreciate the cooperation.
Well, we're happy, speaking for each and every bank CEO in the room, we know the importance of the two entities working together. I think where I want to start, and I also appreciated the time you took to identify the important role banks of all sizes have played with regard to our economic recovery, financial stability, the creation of economic growth and jobs, and financial inclusion. And I think that I wanted to start there because it's something that, and we appreciated the unveiling of the national strategy, and we've worked very closely to bring the unbanked into the banking system, and because you can't have a financial future until you can get off that hamster wheel of the payday lenders and check cashers. So as we've been thinking about financial inclusion and the importance of offering bank-on certified accounts, this is where a friction is created. So we're deeply interested in achieving that, but then you have some regulation that creates friction that makes it even harder for banks to do that. In this case, Reg II, which I know you don't have direct oversight for, but how can we work together to eliminate frictions like Reg II that get in the way of a shared goal that you and I have of bringing the unbanked into the banking system and giving them a financial future?
Well, I think it is an important goal, and we really appreciate the cooperation. I think we've made progress. We made progress during the pandemic, and the bank-on accounts that are simple, low cost, avoid large overdraft fees and the like, that's really an important start in financial inclusion. And I think the banking system needs to work with the regulators to understand what the barriers may be to providing the products and services that we need to improve financial inclusion and see if progress can be made that keeps the banks safe and sound, protects consumers, but also works to facilitate inclusion. So I know when I was at the Fed, we had regular meetings with banks of all sizes, community bankers, regional banks, and the like. And I think ongoing, honest communication to try to understand where problems arise and how trade-offs can be mitigated is important there.
Well, that's great. Reg II is one of these barriers to financial inclusion, so appreciate the dialogue around that. Sticking with regulation before I segue to a couple other topics, we have talked about kind of the regulatory tsunami, all these independent agency regulations, each one not a mortal wound to a bank, particularly a bank, but in aggregate, the cumulative impact is a lot. And don't you think that's something we should study? And if there was a government agency that could do that and look at the cumulative impact of all that regulation, particularly on our nation's economic prospects going forward, would that be a valid exercise?
Well, I think it's something that's important for the bank regulators to be doing. And certainly, we have been hearing loud and clear from the banking community that the burdens of compliance have become quite extraordinary. I think one principle that's helpful is tailoring, trying to make sure that the complexity and severity of the regulations fit the footprint of the activities of banks of different sizes and complexity. But there are so many areas that are important, to my mind, no longer being directly a bank regulator, but worrying about financial stability and the strength of the economy, knowing how important it is to have a healthy banking system in order to have a healthy and resilient economy. I guess my predilection is very much toward robust capital liquidity to make sure that we do have a banking system that can support the economy, that's safe and sound. And I think, a lot of people worried in the aftermath of the financial crisis. Dodd-Frank was passed, regulation really ramped up at that point, that the United States banks wouldn't be able to compete, that the regulatory burden was so severe it would make our banks non-competitive. I think if you actually study what's happened, you'd see that that wasn't the case. I mean, I'm not denying that there are significant burdens on banks, but I think we have a strong, sound banking system that's very well placed to compete. And when the pandemic struck and we saw a huge amount of financial turbulence, I think we were really fortunate, and it aided our recovery, that we had a banking system that was able, in an emergency like that, to provide businesses and households with the credit that they needed to survive what was just an incredible stress. So I recognize that there is a substantial burden. It continues to evolve as we deal with the cloud, with non-banks, with third-party service providers, with cyber attacks, and a growing list of matters that all banking institutions need to be attentive to. But I hope that tailoring can help to reduce the burden for the smaller banks.
Well, thank you. We agree. Maintaining the tailoring footing, we think, is very important. A couple other quick ones. Fraud. During my State of the Industry speech yesterday, I talked about fraud and the idea of establishing kind of a whole of government fraud czar at the White House to help coordinate what's happening at Treasury, the FCC, the justice and law enforcement entities, to create a more holistic fraud government, whole of government architecture. What are your thoughts on the need to create an entity like that?
So I haven't really thought through whether such an entity is needed or could be effective, but I absolutely agree with the premise, which is that fraud is becoming a huge problem. It seems like a growing problem, and we're seeing that nationwide. For example, with checks, government checks, we're seeing a huge increase in fraud around them. At Treasury, we've taken steps. We're now using artificial intelligence it's really made a dramatic difference in our ability to detect and deal with fraud. I thank you for ABA's efforts. I know that you've been working with the U.S. Postal Inspection Service to try to get out information on how to use checks in the mail safely for your members and for the public, and I think this is helpful. We're trying to engage more broadly in strengthening our anti-money laundering CFT entire framework to deal with other kinds of fraud in the financial system. And the approach that you're suggesting could be useful because it does involve the banking community working together with many different pieces of government. So it certainly well worth considering.
I'll take the endorsement. I'm just kidding, Madam Secretary. Last one, and I mentioned in the introduction to you, you are a historical figure in a really cool way. And so I won't ask you to say which is the better job, the Treasury Secretary or the Fed Chair, because we all know it's the Treasury Secretary. But what's the best part of each job that you've had? That's our final question as our time is elapsing.
They've been terrific jobs. I have to say the thing that so impressed me, both at the Fed and at the Treasury, is the quality of the personnel, the dedication of civil servants to the public good, their expertise, their dedication, their professionalism, and it's really an honor to get to work with individuals who care so much about making the world better and using their skills to do that. But, you know, both of these jobs are concerned with the broader economy and financial system. And we want to have a successful economy in which individuals have opportunity and can thrive. And the financial system is critically important. It's the plumbing of our economy, and it really needs to work very well in order for our economy to function well. And in both jobs, in different ways, what we're really focused on is a successful economy and strong financial system that can contribute to it. I've loved both jobs. I will say that while I was at the Fed, I thought that the responsibilities were immense, but the truth is that at the Treasury, they're really more immense. There's just a huge range of matters, from tax policy to sanctions to a $35 trillion government debt to manage. That takes a lot of time and people. The Internal Revenue Service, I guess, is which we're really trying to reform to make it something that works much better for the American people.
Well, we're committed to doing our part to help strengthen the economy. Thank you very much again for being with us, Secretary Yellen, and thank you to your service to the nation. For those of you watching on X, this concludes our 2 days of live stream programming. Thank you for tuning in. We've got one more session from everyone here in person.